Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, December 14th, 2023. It's 1:47 p.m. Eastern Time as I'm starting the video, and here's what I want to do in this one. It is we are now have the Fed meeting out of the way, and we still have, or at least may continue to have, what I call post-FOMC noise. That's just volatility that accompanies Fed meetings, particularly ones that markets real interested in. So I made it clear. I got a post out to you today covering a lot, not every single trade I've thrown out there, but most of them recently. The main ones that I have, and I'm going to show you a couple other trade ideas in here. But most of what I want to do here, I'm going to keep it on topic, on task. And that is cover the big two, really. We'll leave currencies out of this one. The euro certainly did; those divergences did play out, and they played out strong, and that led to the pop in the stock market and gold and the dollar. I'm talking about the euro here. Well, now that I've said it, might as well bring it up. That's EUR/USD. Remember we had that divergent low recently, and that's post-Fed right there. What happened? We took us right back to where we were the other day on that high. So I'd say that divergence has certainly played out. I'm talking about this divergence down here, which is actually a little smaller than that negative divergence there at the high, and it played out for an equal move. In other words, that was the drop from the divergent high right there, and there's the rally off the divergent low. I'll use a different tool next time. Okay, that's that. But here, let me get to this. And what I'm going to do is answer. There's quite a few questions. Both today, I started answering some, typing those in and putting charts. And then I looked at yesterday's post, had a bunch of questions too. So I'm going to try to answer all of those. And most of them are related to the stock market or these trades. So here's what I'm going to cover, roughly in this order. Well, I'm going to loop out of here, just show you a couple other things that stand out trade idea-wise, and then I'm going to go into treasuries. It won't be super long, but I'm going to look at the charts, show where rates may be going, give you my 2 cents there, because that has absolutely affected the market recently, and I think it'll be the theme going into 2024. So I'll get to that in a second. And then I'll go to the equity markets, including IWM. Somebody asked for an update on the small caps. Absolutely, there's something I need to show you there today. Some very, very important things. And then the semis as well. There was a question put there, and that is one of the sectors that I'm just going to say it now. Most of you don't want to hear it. I'm like super excited and bearish about the semis outlook for 2024 and 2025. And again, I'm going to give you the levels, give you my charts, if you're interested. And then of course, a lot of what I'm doing here, just keep this in mind, a lot of what I'm doing here is long-term analysis in this video. So if you want to know where the market's going to go today, tomorrow, next week, maybe speak to that briefly, but this is going to be and I'm going to try to do the same thing right around the beginning of the year. I did that last year. I did a video for outlook for 2022. Extremely prophetic. I covered in there things like Nvidia, calling that thing down 80-something% to the T, and a lot of other stocks too, and the market down to the levels that we hit, which were price targets on the weekly. So we're gonna this is sort of that. We're a couple weeks away from the end of the year, but this is my 2024-2025 outlook. Hopefully you find it useful. Let me jump into since that's kind of off topic, but I mentioned a couple, I'll give you some trade ideas. I mentioned this one. I had it on my notes to share with you yesterday, but then the video and most of the videos I've done lately, because the Fed meeting and everything have been focused, I've tried to keep them on topic, big three. And I also haven't seen a lot of individual stock trade ideas that have excited me lately that really stood out. But this was one yesterday, so I took a small shot here. It was at really nice setup. And again, I didn't mention in the video, but I got it out to you this morning. And it's already now, it's hit T1. You can see perfect reaction right on T1, 7109. And then this is still the potential. I had it handwritten in here, potential T2, a downtrend line if we keep going, and price resistance there. But as T1's the first target, likely get a pullback. Obviously, there's a gap there. You could really put that as T2 if you're in this one. Took it, got it this morning. There it is, big positive divergence, divergent low, big spike on that red bar right there. That's potential selling climax. And at this point, no, you don't take it at all. You do what you want, but it's already right. It just kissed that first target today that I gave you earlier. It's high today of pretty much 71 right there. All right, and another one that stood out. I had a price alert a couple days ago, but again, I haven't been posting a lot of the individual trade ideas focused on the market. But I had actually it was last 2 weeks ago, Progressive, and here's again, I wanted to share this because these insurance stocks are getting clocked post Fed. So there's something going on there. They should be rallying. Insurance companies are typically rate sensitive. I mean, what they do, I don't know if you're familiar with this. I used to be a licensed insurance agent, not property and casualty, but life, health, and variable annuity. And but historically, what they've done now in recent years, with all the financial engineering in the market, things have changed. But the historical model for insurance companies is take your money in premiums, insure you against your house, your life, whatever it is, your boat, your car, and stick most of that money into government bonds, safe things, and earn interest on that, not game the market and all that. So anyways, you would think that the Fed pivot would be bullish for them. And again, a lot of that was, but remember, and I say this a lot, and you just can't forget this, the markets are forward looking. They've, how much of what's already happened has been priced in since the run off the July lows here in Progressive. But either way, it had a beautiful trend line. It broke down, it started going down, had a little pop into yesterday, but look at these, boom, boom, getting smacked down with some pretty big red sticks. So what that is certainly a breakdown. And like I say, sometimes you break down, never look back. And quite often you have a kickback rally, whether it's a back test of the trend line or a little snapback rally. And all that did was extend the divergence you can see there, and still had big negative divergence. Last time Progressive had a divergent high on the daily chart, the stock fell 25%. And it's not just Progressive. When I see that's only when I had the alert on. We had a previous trade on there down there. Chubb, CB, look at this. Just in the last couple days, down 5%. Now, look, it's at a trend line. So if you are bullish, you can certainly make a case to buy it here. But when I see things with negative divergence, just like, positive divergence down here is bullish. Divergent low, and you get a rally. Divergent high, bearish rising wedge, right? I keep telling you I'm not going to use that tool. It's bugging me. I keep clicking on it. I need to take that off my little tool shortcut there. There it is, wedge, divergent high. You get the point, guys. You can see it, divergent high. It's supposed to be a DH. Divergent low, DL, and divergent low down here, DL. Wash, rinse, repeat, right? Boom, boom, boom. So it looks like the run may be over in the insurance sector. There's Travelers, a little small, but still divergent high, taking it right back to support right now. So being that Chubb and Travelers are right at support, you don't short here, but you keep an eye on it. They break down, that's a pretty significant subsector of the financials right there. Allstate starting to crack below this bearish rising wedge, big red candle, and in some cases you have some bearish engulfing candles on these guys. So I just want to throw those out there. I'll keep an eye on them, and I'll tell you what would I'd like to still see in order to start engaging this and other sectors a little more aggressively, more than just taking starter positions or holding off. I don't have anything in the financials, so I didn't take that. I got been keeping things light heading into the Fed here, but we still need to see those trend lines get taken out. Remember on QQQ and most of the market leaders I had, and I've added some secondary trend lines here. There's SPY. I'm talking about this one on QQQ right there. And then shorter term, remember yesterday, right before the Fed meeting, and look, we just took it out. I just had a price alert on this. Remember this short-term, very short-term trend line? I said you can draw it in a 15-minute chart, and that's what I did here. We were right here, right before then, and we went down. There was the Fed pop, and that trend line held like a champ. So based on that, if you were trading around the Fed or wasn't concerned, you wouldn't have taken it, added to, or initiated a short. But now you can. As of right now, we just took out that trend line. And there's that bigger trend line on the 60-minute chart. And I'm on the market, so let me just rifle through the things. But let me just recap. This is a 60-minute chart. I have different boards, but nothing has technically changed. I know I've done this long enough. I don't even have to read the comments, but I'm read the comments. There's a lot of folks, and I get it too, especially if you had too big of a short position or you've been short for too long, that nobody likes going underwater. But it's where a lot of folks seem to be giving up. And the bullishness has just reached some pretty extreme levels. I showed you on the AAII survey the other day as well. Now, I'll tell you, I'm not seeing them on the put-to-call ratios yet. They haven't hit my extremes, but it's something I'm watching. And I'm also watching for credit spread divergences. I'm not seeing much of that either. A little bit, I'll tell you, a little bit, but not as much. However, I have started to see, as I pointed out last week, remember, it's not every single day, but I've seen that disconnect between the very, very, very strong correlation between bonds, particularly treasuries, and the stock market. So there's the wedge. This is the 60-minute chart of QQQ. That's the larger, more significant uptrend line that needs to break. And again, I know yesterday, the price action, it's just a Fed day. And you take it with a grain of salt. Any big up or down move, especially if it doesn't change anything technically. Kept that near-term uptrend intact, even kept that shorter-term downtrend line I showed you intact. So nothing's technically different. The divergence is just stronger now. And I'm going to show you why we're here, because I don't want to forget this. Divergences, I always say this, they're not the be-all, end-all. They are a big part of my trading, my analysis, and much more often than not, if it's clean-looking divergence, by that I mean you have a clean separation in the PPO and RSI, where you have these valleys, if you will, or troughs between the peaks and the highs, and then you roll down, then more often than not, they play out. And when I say more often than not, I'm not talking 51, 52%. I'm talking 80, maybe even 90% a lot of the time. And what I really like to see is that confirmed divergence by the PPO rolling over, and we're still moving up. I always say that these momentum indicators, PPO and RSI, are momentum indicators, and the momentum right now is pointing that way. That way is up, and if they keep going up, the divergence is taken out. So what I want to see, and I'd prefer to see it soon, and you need to see it soon here on the 60-minute RSI. Again, I'm not using a straight line. It's equal highs. That's still negative divergence. So you really need to see things roll over here, or you get it taken out in the RSI, and it's just not as good. It decreases the odds when you don't have it on both. Doesn't guarantee. I've seen one or the other have divergence and a turn come, but I just wanted to point that out. So looking closely, and you can see right there, I don't think you can see it in the video, but I can put it up for you. We're getting close. I always say it's that bearish PPO cross. Actually, we just got it, just ticked. Look, negative 0.01. Now the 60-minute candle must finalize, and you don't want to have to squint. I can see it, but I have a purple line right there. You can see that. But we've crossed. Oh, there it is. When I move it, you can see it better. Let me just take that line away, or yeah, I'll just get rid of it for now. And so there is, and what I mean by that, guys, this is just me, something I developed over years ago. People will point out divergence, and technically when you have lower highs in indicators and higher highs in price, that is divergence. But it's confirmed or official to me when you have a bearish crossover in the PPO. So I'm going to, let's see here, put a circle tool. That shows you right there. You can't see it probably looking at the video. Again, it's just something that helps. It's not I don't put a super, super duper high weighting on it, but it shows you now the momentum is waning and that's shifted. We'll see if it sticks. But what I wanted to show you while we're here, very important, and you guys have probably, if you followed me for a while, you heard me say there's very few things in trading that are more bullish than any type of failed bearish setup or breakout. When you have a clearly textbook-looking bearish pattern, and either it breaks out, or more importantly, if the breakout happens, a breakdown, and a sell signal is triggered, but then things reverse and it proves to be a whipsaw. Because the reason that's so bullish, it's twofold. Number one, you have all the shorts that took the sell signal, and their stops are now hit. They have to cover. They see they're wrong. The breakout failed. They're either going to mechanically cover, or they're going to have hard stops they place that are going to be hit above the breakdown point. And on the flip side, the bulls are, sharks, small blood in the water, and they come in, they see the breakout failed or the breakdown, and they step in and buy. So what I'm showing you is, here is an example that we had, and I was highlighting back here, and it never played out. This back here. I can probably come in a little tighter for you. we had a case, and that was in earlier this year, in April and May. We had pretty nice divergence, building, and we also had a trading range. I expected, because of the divergence, that trading range to break to the downside, but I also stated at the time, whichever way it breaks is the way we're going to go. And we broke. There was one little whipsaw down to the bottom. We snapped back up above, but then we broke out and held it, successfully back tested it, and then once you started walking away, that was it. And at this point right here, we had divergence, still had it there, and then what you can see is the divergence was ultimately taken out, or what I call negated. So you had negative divergence that was then negated or taken out, removed, and with prices just powering up on through there. And it was a huge move that followed. Most of that, if you recall, it was NVIDIA that really did it with a blowout quarter, and that just kind of set the AI hype going. And then everybody it's just like the dot-com bubble. I swear, if you've been around long enough like I have, if all you had to do in 1999 is put the word .com in your name and say you had a .com company, and it didn't matter if you had a business model, or didn't matter if you had earnings, didn't matter if you had proven management. That's all it took. And it's kind of the same with AI. It's laughable how AI has been around. It's nothing new. ChatGPT just kind of made a lot of people aware of it, and then Google and Microsoft, and they were the first. Or first it was Microsoft with Bing and integrating ChatGPT. Anyways, they started slapping that on their name and kind of associating themselves, branding themselves with AI, and so that lifted all those Mag 7 up along with NVIDIA. Anyways, enough on that. Okay, so that's it. But then, here is a divergent high right there. Pointed that out. We shorted it. 12% drop. We covered right at the lows, went long. And so these divergences, again, if you go back far enough, they work more often than not. And I'm saying this because I know most don't want to hear it. I can see from the comments they're getting tired of it. And when the divergences are gone, guess what, guys? I'm not going to have a strong case to be making on the at least on that time frame for a reversal. But right now I see it, and so regardless of what the Fed did, the Fed pivot was so telegraphed. It's probably the most telegraphed move ever. The Fed Fund futures had a virtual 100% certainty the Fed was going to pivot. And we knew that before. We knew it at the last Fed meeting that they weren't going to hike and they were going to hold. And they held again. They didn't cut yet. But so anyways, just the market's reacting to kind of old news. And hey, it's price action first, whatever. But let's go through the remaining charts. I told you I was going to do bonds first, and so I lied. I just wanted to talk about why we're on that 60-minute chart of QQQ. I wanted to talk about, show you, yes, there are cases. I've seen plenty over the years where divergences, bullish or bearish, didn't play out. And again, that's usually pretty darn bullish or bearish when that happens. Longer term, let's just go to my chart TYX. That's the yield of the 30-year Treasury bond. Most of you know I've been unwaveringly bullish on those till recently, putting on last week, a week ago today, I think it was, short trade officially on the site. So taking out a lot, not all, but a lot of my longer term funds that I shifted into recently. And I just want to say that my views haven't changed. I still see more downside in treasuries. And again, I just want to reiterate for those that haven't heard me say this in the last few weeks, what my expectation is, and I'm starting to see early signs is a disconnect where we've had hypersensitivity. This is when the 30-year broke out to new multi-year, even multi-decade highs right here. That's when the stock market, that 12% correction came. It didn't like the fact that thought rates were over here. Market cheerleaders were calling a top in bonds back then, saying buy bonds. Rates dropped, but then they went back up and they got even higher, and that's what rocked the stock market. So this is and was a beautiful bullish falling wedge. It broke down, and by most accounts, but I'm going to put a line here. We are at support, and I made it clear today, just like the QQQ trades and my mark index or semis, all that. I'm giving that until next Tuesday for the reason I mentioned. I suspect at most, again, I suspect at most the post FOMC highs will come on Monday. Could already be here. We'll see. It faded this one today and turned the markets red already. However, that's just, we'll see what happens over the weekend. And then I give it 1 day for margin of error, and that's it. By the close on Tuesday, I'm going to set stops above those previous, whatever the reaction high. It might be the reaction. We might rally into the close on Tuesday at 4 p.m., and that's where my stop will be. Or we could have peaked Tuesday afternoon or Monday afternoon or even today. And that's where my stop will be. So I hope that makes sense on those two trades. It's a little atypical, but I've done similar stops like that before. All right, so where we're at, you can see these lines right here on the 30-year yield. Boom, 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 boom. They were resistance, and resistance once broken becomes support. So that's there. And now the wedge doesn't seem to have met, it certainly hasn't met its measured target. That's the widest part when I'm going from this part of the wedge down to the bottom. That's the widest part. That you add that to where the wedge breaks down. There's your measured target. So this tells me most likely whether we, I'm just looking for, I suspect, a pop in yields from here on or around current levels, and then another leg down. So that's where I want to be short treasuries. And the market won't like that. Any significant, not 1 day, but a multi-day or a significant backup in yields will wake up the market and put the brakes on the rally. Can all but promise you that. All right, so that's it. And then bigger picture, and this is very important. It goes into my analysis. This is why I wanted to do this again. I've covered this so many times over the years. That's our secular bear market downtrend line and interest rates. You can go back on the 10-year bond. This is the 30-year yield. You can go back on the 10-year yield, the 5-year, and they all peaked right there in the early 80s, right there in 1981. And we've been in a secular bear market in rates, which is a secular bull market in bonds and stocks and bonds. The stock market in the economy thrives on lower and falling rates. And so that ended in what I believe to be a generational bottom trough in rates when the Fed went all out. All these little spikes here that's 2008. These are the artificial manipulation, the rounds of quantitative easing and ZERP. But every time they'd fired off, and then they pulled what I can only refer to as the nuclear option when COVID hit. The Fed freaked out, the federal government freaked out, everybody freaked out, like aliens had landed on the planet. And so, they threw unprecedented amount. I mean, a lot of people was jaw-dropping what they did in 2008. And that just made it look like a walk in the park, what they did back here. And so we're still, still a lot of that cash is still floating around, and that's what's carried stocks. But again, I'm giving you my analysis. So I've been predicting this for a while. I've been predicting the breakout and that we'd end and enter a new secular bull market in rates, rising rates. But I also said right here recently, I'm highlighting these bearish rising wedges and the clean up trend line. That's what broke down recently. And I said in recent videos, I see it anywhere. I don't have a hard target, maximum. And again, this would be and should be, but not necessarily net bullish for the equity markets, would be a back test of the trend line. That would be my maximum drop in yields. That means bonds would have a very strong rally in 2024, 2025, if that happens. But I also have support levels here. We may not go down that deep. I just don't know. I can see, the case to be long. That's when we went long. We nailed the bottom on bonds, which is a top in rates recently. Traded the 30-year. I'm on the other side of it right now in the active trading account, but and you can see here, and I stated the reasons why. So just again, don't underestimate that. Now, before I leave this screen, again, I'm reiterating what I've said repeatedly a lot, is that I believe we're going to see at some point next year, or going forward from here to 2024, maybe into 2025, a disconnect from that very strong hyper correlation between bonds and stocks, which is an inverse correlation between yields. In other words, I think we may continue, or will at some point. I'm not sold on it or married to it, but I'm very open to it and leaning towards it, that we'll see yields, continue to go down. Again, not straight down, but at some point that will stop being bullish for the stock market. At some point it will be various reasons. It'll be a flight to safety. Could be other things. Anyway, so I just want to point out, near term, again, we're at support. There's support on TYX right there. There's the wedge that broke down, but there's some support. And then TNX is your 10-year. And you can look back on the monthly. I told you, same story. You can go back all the way, early 80s, exit Jimmy Carter, enter Ronald Reagan, peak rates, Volcker, the war on inflation, was one. And but then the Fed just kind of got a little emboldened with the fact that, they just keep marching rates lower and lower and lower and lower until they couldn't go lower anymore. And then things started breaking. So that's where we're at. And the 10-year, again, also just broke down. Again, these were beautiful trend lines, big divergences. It was one of the highest confidences I've had in a trade in a long time, shorting bonds, or going long bonds recently, shorting yield, if this is what you would call it. And again, these are potential. This is a really good one. So I'll tell you right now, I don't think we get back to this trend line, although we could. And I'm very open to it, because if what happens in 2024 and 2025 to the stock market, if that what I think is going to happen does, you're going to see a very aggressive measures by the Fed, and you could see that. Otherwise, I'd say this is a very likely target, and an area will probably bounce. That's about 3.10. So there's still more downside I see in yields, more upside in Treasury bonds from a bigger picture. You get a step down and you go to the, you go to IEF and other things like that. And I will give it points. IEF is broken out now. It's had a little price resistance here, but more importantly broke above that trend line. Let's see, TLT also yesterday. But we'll see how we finish the week, because on TLT, remember, you have a really good resistance right there. TLT is the long 20 to 30 year. Okay, so there's my kind of bigger picture on bonds. I don't want to spend too much more time on that. Let's get to the stock market. I know a lot of folks don't trade bonds, but even if you don't trade them, 401k investors, believe me, you only have a few options in most 401ks. Most of them are going to give you U.S. stock funds, international stock funds, and they're small, mid, large, bond funds, and cash. And that's about it. Most, again, the majority of 401ks, that's what I used to do. Financial advisors, they don't have gold fund and silver fund and Bitcoin and, all kinds of niche sectors and other things. So this is an area, over in the coming years, I think there's a lot of money to be made in trading bonds, both long and short. So I'm always going to include that. And again, it's important to know where bonds are going or yields are going in this environment where stocks are very sensitive to interest rates. So enough on that. Now let's go into, I'm going to start in order with QQQ. We already started there, but I'm going to pick back up. This is a daily chart. We're just going to talk on a few time frames, but again, I'm going to gear this video kind of longer term, bigger picture stuff. I already started out real quickly showing you the minor uptrend line that I highlighted right before the Fed meeting right there. Whenever it's not a super great trend line. This one's a little more significant right here, off the lows. There's our big divergence line. We had a divergent high back in July when we went short and yields got up. That gave us that 12% drop right there. Then we took out, that was bullish, took out the downtrend line right there, moved on up here, and there's where we're at today. So and that's what I'll wait and see what happens by next Tuesday. And just to make it clear what I'm talking about, like let's just say on Tuesday we're down here, well then that's my stop above today's high. If we go up tomorrow or Monday, then that's, or even on Tuesday, then that's my new stop. Alrighty, weekly chart. Very important. I cover these weeklies. They mean a lot to me. They're you don't use the weekly or the monthly if you're a very active trader or you like to get precise on your trades. What I mean by that is, you turn on CNBC and Bloomberg and they march analysts and they make a call. They're going to call a price target on XYZ of 180 or share, and it's at 100 now, and they don't say when. It's not a hard target. My target's a little more precise, as well as the entry points and all that. However, when you get out to the weekly and the daily chart and the monthly charts, that's kind of just helping guide the big picture where things might be going, and where if you're looking at a trade, and I see a big move priced in on the weekly chart, bullish or bearish, then that's going to determine how long I might hold that trade. Is that a trade? Is that also a trade I'm going to take in long-term accounts, IRAs and other things that I don't actively trade in, and I'm not going to try to game all the little squiggles, meaning all the bounces and pullbacks off the targets, from T1 to T4 or 5, whatever, how many targets I have. Okay, so what we have here, I'm just going to give you the raw, take on everything. That marginal new high scenario that I've been talking about since September is certainly in play for QQQ with a marginal new high. It's pretty much now an equal high to that previous, close enough. I can't even tell over there. It's close enough. Again, you turn off all the lines. You can see can and I will. I'll put a line on there right now. That line was right there. So we're a hair below it. I have to tighten it down. Hair below it, but for all intents and purposes, it's pretty much there. There's the uptrend line I showed you before. There's the divergence. Now this divergence is not even close to being taken out. Again, it could ultimately be taken out. We go up, PPO goes up. Once it crosses above that previous high, it's then negated, and that's going to be pretty damn bullish, and we could be looking at a rock in 2024 in the stock market if that happens. And unfortunately, and if it does, by the time that PPO gets up there, I'll be out of any, maybe back in at the time, but I'll be out for now. So that's it. And it's still unconfirmed on the weekly chart, meaning we don't have a bearish PPO crossover. In fact, the last time I highlighted this one on the weekly for you, told you it was a sell signal in itself. Do you look for these high-level bearish PPO crossovers, especially when you have clean separation in the lines like this? And that was right there, and there was plenty of downside left. So we're going to look for, I'm going to look for that. I'm going to look for the bearish PPO crossover. I can even set an alert, and it'll tell me when it happens on this time frame. But I'll watch. I look at this chart all the time. And then, kind of just reviewing everything that's happened. The last divergent high we had on this weekly chart on QQQ was right here. That's where the divergence ended. And that was that. And this is a weekly chart. And it was pointed out at the time. We had sell signals on the shorter term 60-minute charts that got us in, that got us short at the top. And as I covered the other day in the video, I had initial targets on the 60, but as the trade was still in play, I started then turning to this weekly chart and laying out and provided these targets for you here, these longer term T1, T2, T3, all of which were hit, and T4, which at the time I called 235 and or the blue uptrend line, figuring we'd probably come in at the same time. 235 still not been hit. Neither has that blue uptrend line, and those are still longer term targets. So we'll move that over there. Go back in time. Previous divergent high was right here on the, right here, COVID. Remember, COVID was not a random event. We had RSI RSI divergence right there, and about equal highs on the PPO. And you had that 36%. It was 36 in the S&P. It was a little less, the drop. I don't have them measured on this board. I'm going to show them to you on QQQ. That was also double-digit drop. That was what we called the taper tantrum, and I called that one. The Fed had started to raise rates back then, and the market threw a hissy fit. Didn't like it, just like they did recently. And then the Powell pulled a 180, cowed down to the market, and gave them back what they wanted. And so that's what that was. There was your previous divergent high. And let me just show you, let me flip over to the S&P because I have these measured. This is easy. Okay, you're looking at, turn off all the lines. You're looking at what is still, if you just view this chart, it depends on how you want to look at it. But by most accounts, this is just one big bull market off the March 2009 lows. That's when the previous real recession ended. Back the Great Recession, 2008, 2009, the financial crisis. And you can see we've been marching our way up there, right? Turn back the lines. You can see here, I have several lines on here. It gets a little busy, so I'm going to zoom in. But before I leave that, what I want to show you, I'm going to zoom back in so you can see better. And again, if I missed any, let me know. Put it in the comment section. But I believe I have them all here. I've had this chart for a while. What I'm circling are all the divergent highs on the weekly time frame for the S&P 500. Again, much more of the stock market than the Nasdaq, especially lately with the unusual outperformance. The FANGs, the Mag 7 have always had the highest weighting, but we've never seen this is unprecedented. The amount of performance in the last year or so that has been attributed to just those 7 stocks. We've never seen such differential between those 7 and the remaining 93 stocks in the NASDAQ 100. So there it is. There's all your divergent highs, including this one. I'll zoom in on in a second. That one back then, the bear market was about a 57% drop in the S&P 500. This one here in the bull market was still a 22% drop. We had one there. It was 10. There was a divergent high right there. I didn't circle. Then we had 2 back-to-back, about 15%ers off this one. This one was 21%, roughly. That was a taper tantrum in fourth quarter 2018. COVID was 36%, also divergent high. You can clearly see all the divergences on this chart. That one, which was, again, I consider the first leg down in a new bear market. Others consider it a bear market that's over. Only time will tell. But that was a 28% drop. If I measure that correctly, I believe I did. Yep, about 28%. And here we are, full circle. Negative divergence. You can see clearly, not at any risk of being taken out at least anytime soon. Now, if we keep going up over the next few weeks or months, yes, that divergence may get taken out. We're also overbought. You can see last time we were overbought was right here. And then after the overbought condition, shortly after that, right here, you had a bearish PPO crossover. And those two things I like to look for. I'm going to get to that in a second here on the small caps and show you something. Same thing back here. Remember, you were overbought in a bull market. And this is something I talk about often. The RSI tends to behave a little bit differently. In a bull market, you tend to become overbought and either stay overbought for an extended period of time or become extremely overbought. And in a bear market, it's usually one and done. So boom, it was one and done there. We're getting close enough. We already have negative divergence. To be honest, I'd rather see it reverse before we take out that previous high, keep that divergence clean and intact, for the bearish case, that is, of course. And again, these are things, guys, it goes the other way. If that doesn't happen, if we go up, we no longer have divergence. It whittles away at the bearish case. It just does. All right, so that was, again, persistent overbought conditions, but we were diverging. Those highs on the RSI were lower and lower. That's what the negative divergence is. And then finally, if you put up the histogram, I think the bearish PPO crossover came right there, and the top was in. So I showed you the levels. Oh, and these are, so you know, these are targets. This was all back here. I made this back in this one for the S&P back in March, beginning of March, near term, meaning, I was looking at a longer term drop. And so I give you near term T1 hit. We hit it 3 different weeks there, bounced. Near term T2 hit, we bounced. Long term T1 hit right there, and my long term T2 and long term T3 have not been hit, and I still favor those being hit. And now you can see long-term T2 comes in with this uptrend line. So that's going to be one in the same, if it happens, roughly like that. And then, again, we go up here, take those divergences out. You might have some longer-term, bigger divergences, but we'll see at the time, from this peak to this peak. But right now, that's what we have. No sell signals on this weekly time frame. Nothing remotely close to a sell signal. Nothing but green sticks. So, we'll continue to monitor it. Monthly. This shows you, again, what I showed you. Well, no, it doesn't. I'll do it here. Divergence. If the S&P makes an equal. So this is important too. This is a monthly chart. Any equal or marginal new high anytime soon, you can see I can lift these lines, will still be big divergence on the monthly. You don't get that often. This is a monthly chart. This is your trend trader, 401k type stuff. We had a divergent high back there in the late 90s, followed by a 20% drop. Divergent high right here in mid, that was Asian Contagion, 98, 23% drop. That divergence continued to grow, got bigger up to DH2, 51% drop, i.e. bear market. divergent high leading. Again, on the monthly, you don't have a lot of these. They're very rare to get on the S&P 500 to get negative divergences. And they're highly accurate. Again, I look at probabilities. That's what I do. Is play the odds, not possibilities. Anything's possible. Probability is when you get these monthly divergences, you're going to get a double-digit drop. You're going to get corrections. 22 was it? Actually, you know what? It's funny. I don't have it marked, but it was. I had that drop marked, 22% right there, but I didn't have that divergence marked, and very much was right there. If I did it right. No, that one's not there. Take that back, guys. I'm looking here. That's why I didn't have it marked. I moved the lines wrong. But we had a 22% drop. That was a divergent high, 15%, plus a sideways market for 18 months, almost 2 years in that range right there, where we just went sideways and those divergences played off in a correction in time. Divergent high, 20% drop. Divergent high 1. Divergent high 2 was right here, COVID, 36%. Divergent high right there on the RSI, and 25% drop, and that's that. Okay, guys, big picture stuff. And I have 2 words, if you're wondering how it's going to play out with the Fed lowering rates. The 2 words I have for you are lag effect. I and I think some others believe that they're almost immutable forces in economics, in the economy, and that will, one of those, especially with debt levels and everything else out there, the rising rates will matter. There were a lot of companies and individuals fixed in. These rising rates haven't hurt you or I and our mortgages because we haven't gone out. If you have a car, bought a car, or you're leasing, and so only when that you go sell the current car, or you get a new lease. And then we know that statistics show us, and we know the numbers. There's a lot of debt coming due in 24 and 25 for corporations, and so look, and that could also be. And I know the bulls. That's the bullish case right now. I go back to TL. Let's do TNX at the 10-year bond. And that is the bullish case that if those companies are coming rolling over, the lower this goes, the more bullish that's going to be from that aspect for 2024, 2025 but I can't tell you what'll happen. I mean, I know what'll happen, but you won't believe what'll happen if everyone thinks it's going to do this because the Fed's done and we do that. It's going to be, I'd say, I'd use the word catastrophic for the stock market if we go up and we take out those highs and we continue up in rates. But again, like I said, I already shared where I think they're going. I don't think they're going to do that anytime soon, but just watch for it. That's all. If you start seeing rates tick back up and do what everyone else doesn't think they're going to do, then, and that's the scary part. It seems to be a very one-sided trade and very concerning unanimous view that interest rates are only going to fall from here. And maybe they do. Maybe it's priced in. Maybe they do. Maybe it's not all priced into the stock market. We'll see. Again, that's why you trade each chart on its own. And at some point, like I said, I'm calling for that disconnect between the hypersensitivity with the stock market and bonds. Okay, on to the smallies. Smallies, I'm referring to the Russell 2000 Small Cap Index. Somebody put a question up today, asked for my 2 cents, said rising, and yes, falling rates are typically a very, very much a headwind. I've talked on this before. The small caps are the most sensitive to interest rates because of their infants. They're smaller companies that are much more dependent on borrowing to continue current operations as well as any expansions going forward. So they rely a lot more on the debt market, on issuing bonds to raise capital than do the large caps. Huge level. I mean, this is the story of the small caps. They peaked back here in a very, very tight trading range. Let me change that color from red. Red, it's an angry color, and purple stands out better. I'll go to that purple color on here. Right there. There's a trading range. We had that false. There's that beautiful failed breakout, and we had above it. It happened with negative divergence. Didn't get us. In fact, we were on the other side of it, but got a lot of bulls sucking in that breakout to new highs. And then when it failed, nothing but bearishness, nothing but red sticks. And this is what happens when a breakout fails. You went straight back to the bottom of the zone. Do not pass go. Do not collect $200. Go straight to jail. IWM fell there. As they do, they came in and that was support, really good support. They had one last little hurrah off that support. Then the bottom broke down. Once that support broke, again, super massive support. Back test. We entered a new trading range right here, right there. Back tested it several times. The bulls could not reclaim it. And then boom, big red stick down through the bottom of the zone. And that has set up since that period of time. This is your new zone right here. Trading range. It's super well defined. It's almost robotic in its form, where the algos and everything's buying here and all I can tell you, and I said it back here, that when you get in these trading ranges, and again, guys, we're looking at a weekly chart. This is a whole year, that trading range. This has been 2 years. It's massive. This trading range right here is probably easily twice that trading range, twice that in scope and or duration in 2 years and in scope from high to low. So what does that tell me? What's the takeaway is, well, no range lasts forever. This one's getting long in the tooth. Obviously, an upside breakout, unless it fails, is bullish. There's no other way to spin that. Again, an upside breakout unless it fails is bullish. So you can buy the breakout. Being this is a weekly chart, if you want to minimize your chances of going long and getting caught in a whipsaw, then you might want to wait for a solid weekly close above here. You can certainly take the breakout on the daily chart, and that may get you in earlier, and you might capture a big run let's just say by the end of the week we close way up here, for example. That's the benefit. So there's always that benefit. You can go down, step down to the shorter and shorter term time frames, daily chart, 60 minute, 15 minute, 5 minute. You're going to get in quicker on the shorter term charts. They're just prone to having more whipsaws than waiting for a confirmed breakout on a weekly time frame. But I don't care who you are. You cannot argue that this is not massive resistance. And so that's it. Now, I pointed out not so long ago that the small caps were the most bullish looking sector right here because that was at that support and with positive divergence. And we had a nice rally. Make no mistake about it. It's not mere coincidence. This coincided with that big abatement in yields. And that was a fundamental headwind for the small caps. Okay, so where are they now? Well, first of all, back when the market peaked, I had these, shortly after I gave you these targets here. This was actually later. 4 targets I gave you, 4 price targets. T1, T2, T3, and T4. T4 is at 144.20. Nice support. I still maintain that target because I still maintain we're in a bear market. I don't know who you can't argue that the small caps. Well, you can't. Actually, I'm sorry. It's debatable. It's semantics. Because, we're not at new lows, so you could say that the bear market ended there, or you can say this is a bear market rally. Again, semantics. Let's not worry about that. But we're well below the highs in the small caps, right? That is a long-term trend line, a potential trend line. It comes in on the COVID lows there, but 144. So if that's hit. We're about 200 now. We go down to 144. That's about a 27% drop. And I'll tell you, again, if bonds if yields continue to fall, fundamentally that is a net positive. Maybe it's too late for that to save them. Maybe the damage is done. Something again that I think I'm a little bit different on than a lot of folks that are out there getting super bullish about this. I'm going back to the 10-year here. Remember, I'll turn off all the lines right now. Okay, and this has been just a lot of euphoria in getting this in the stock market. But what it's done, it's taken us back to where we were. I'm just taking the crosshairs over, right? Back where we were in the beginning of March of 2023. We're right now in the 10-year back to where we were in around October, right there, when the stock market bottomed. So right there, if you look at, again, just take that horizontal line, come across here. Like this, and look at those points we were at back there, and then you take it all the way back to right here, which is, where is that, 2010, 2009, 2008. That's where the 10-year was. So yet the market is pushing at not far off new all-time highs. It's still off there. Not in small caps, not as much, but again, the large caps. So, in other words, I don't think that where we're at now in yields, this abatement, we'd have to come back a whole lot more for it to just kind of negate the lag effect. In other words, negate all this that's happened in recent years, especially because the market has engorged itself, both consumers and businesses, on debt in this uber low rate environment we've had for a long time. So this has kind of been the norm for recent years right here in Treasury yields. I know I'm making this look like a Christmas tree right now, but this is where a lot of since really the financial crisis, a lot of individuals and corporations have financed at and are used to, and then some even a lot down here. Everybody engorged. I bought a home, moved, and when COVID hit, and I had a mortgage that I thought was it was an incredible rate, and so that happened here. But then I was able to refinance a couple of years ago. I don't know where Treasury is, but I got, and I've talked about this. It's amazing. It's what is it? A 2.49% rate, no points, nail the bottom. So my point is that's where a lot of folks have bought, and that's where they're going to stay. So, if rates got back down there, yeah, then there's a huge effect. Right now, we've just had a little abatement, and even if we go a little lower, we're still looking at rates that are at multi-decade or multi-year and even decade plus highs. Okay, so that. I don't know. I just don't think that's being factored in as much on the outlook at equities. But all right, back to IWM. I want to show you one thing, guys. Hang in there. This one's worth it. All right, so what I've done here, this is a daily chart IWM. Remember, we were looking at a weekly chart a minute ago, and I was highlighting these the ranges. I'm going to go to a different board here. There it is. I have that. That's a clean board. You can see in a purple box I have right here. Let me make the lines a little thicker. There's that current trading range, and there's the one I had back there before. We're at the top of the range. It's resistance. And now let's talk about that, because you're saying, okay, we all see what we want to see. A bull's going to look with the bull glasses and see things with the glass half full. A bear is going to look at it glass half empty. I'm going to just show you what I see. Let you decide what we're looking at here. I marked this chart up. I wish I did it on a cleaner board because I have a lot of trend lines and things, but I'm just going to use my circle tool to show you. I have my two go-to indicators. There's a lot of others I use, but these are my go-to, my favorite ones, and that is the RSI and the PPO. And what I have circled here, and I've shared this before, but I've updated this today. I've circled all the overbought readings. Overbought, the default overbought reading is 70 on the RSI. That's the red line. I just colored it over there with yellow, just using this tool. And there's oversold, right? And typically you want to be buying stocks. Typically, of course, you want other confirmation when they're oversold. Certainly not when you want to be, selling and shorting a lot. And you want to be selling, getting out of your longs and or shorting when things are overbought, right? That's pretty simple stuff. Again, simplistic. There's other things that factor into when to get the timing, because like I say, in a bear market, just like a bear market is a bull market in reverse. In a bear market, remember in a bull market, I said overbought tends to stay overbought for an extended period of time. The last time we saw that was right here at the end of the bull market for IWM. It peaked right there. Had that one little false pop, but we've been in a bear market since. It's overbought. This is bull market stuff. Very high RSI readings and or persistently overbought readings. And then a signature of a bear market. I've done this for a long time. It's pretty simple stuff. That overbought is usually one and done, very fleeting. So I've circled each of those overbought readings. Again, time will tell if they were embarked. If the bear market was over right here for small caps, then what you would expect is this overbought reading may stay this way for months. We may dip down below, back above, but I'm going off the, my primary thesis that we're in a bear market. This is a bear market rally, and so I'm pointing out that this is the first time right now that RSI is pinned up there at about 78, pretty high. I mean, there is no 100 is theoretically the maximum on RSI. It never gets there. It's bounded by 0 and 100. But again, the 30 and 70 levels are oversold and overbought. So I'm just circling. As you can see, the circle's already there. Each and every time, without any exception, that we were overbought since the small caps peaked back there. And again, I could go circle the one when the high. And now I have an orange circle on this chart here. Okay, right there and right there. Now I'll flip colors on the tool. It's already on this chart. You could probably see it, and I know you can see where I'm going. I have what I call high-level bearish PPO crossovers of PPO. You have a zero line there. Anything above that, you're positive. So I look for these high-level, clean bearish PPO crossovers. And again, I've shared this before. That one you also had big negative divergence leading up to the bull market high, start of the bear market. But your crossover, I'm sorry, came right after. You can see here, just slightly after the overbought reading. They were concurrent here. There's your high-level bearish PPO crossover right there. Just a hair after the oversold reading. You had one there, but you weren't overbought, so I'm not gonna circle that one. You had a high-level bearish PPO crossover there in conjunction with an overbought reading. Again, you can see that's right there, both of them. Overbought, bearish PPO crossover. Overbought, bearish PPO crossover right after it. Right now we have overbought, but we do not have a bearish PPO crossover. So you may want to set an alert, and that would be what I call a high probability sell signal. Again, here's your track record. 1, 2, 3, 4, 5. 5 for 5 with zero. Really here, you can go back this far if you want to say, this one here, we were overbought there. I didn't go back that far because this is the official start of the bear market. And so that's 100% success rate. A statistician will say, well, there's only 5 sampling. You can only get so much. It's not like life insurance where they can look at millions of deaths to calculate, life expectancy and probabilities and all that. So you're always going to have this smaller sampling pool, but it's been pretty effective. We don't have the PPO crossover yet, so it's something I would certainly look for, set an alert for if it comes in close proximity, especially to that. And the other side, now let's take the bull side. So there is no sell signal. I'm going to make that very clear. We have to have that. That's the second part. That usually comes after the overbought condition, shortly after. So right now there is no sell signal using this dual signal method, if we want to call it that. And if we don't get it, and this is just overbought, and then it becomes, we stay overbought for a while, and the PPO keeps going up, crossover some other point, we break out, then then that just shows you, hey, there's more evidence that guess what? Bear market's probably over. This is probably, and again, as I spoke to a minute ago on the weekly chart, anything other than a failed breakout, and IWM is prone to that, but a breakout is bullish, and so there it is. The takeaway right now, and I'm just going to say it very clearly, it is not objective to go long. This is technical analysis 101. Yeah, you can have a hunch. You think this market's going to explode into the end of the year. It's going to explode in January. Sure, you want to go long. Just set your stop wherever you're comfortable with. Here's a beautiful uptrend line in which to put a stop below or to trigger a short if it's taken out. There's a gap right there. There's plenty of objective strategic levels from today's lows to yesterday's high, the previous close, I should say, the gap to the trend line if you want to do that. And you may position in anticipation of a breakout. But technical analysis 101 or trading 101 says you do 2 things when a security runs up to resistance. You either short it, or if you're bullish, you wait for a breakout above that level. So that's pretty simple to me. Again, this is a clean chart, clean levels. A lot of eyes are going to be on those levels. There's the other reason why, it's a daily time frame. So you wait for a solid daily close. You probably want to call that number 200. It would be, round it off because I have it at 180. So let's just round it up. 199, 200, give or take. And there's an example of if you popped intraday and we already faded back below there. So, okay, I don't want to spend any more time on that. But and then it would be, again, a powerful move because there's been a lot of energy building in this range. If history repeats, every time you went to the top of the range, you got rejected and sent back down. So you can make an objective case to short here, with a stop somewhat above. That stop can be on a relatively tight price basis. It could be on a solid daily close, or even if you want to give it a little more room, which is probably best, on a solid weekly close above that level. Alrighty, I didn't realize how long I've been talking. We're almost at the 1 hour mark, 59 minutes. I don't like these videos to even go this long, so I'm going to do the semis in another video. I'm just going to tell you right now that looking at the weekly chart right here, I mean, this in itself speaks volumes to me. And again, it's like the stock market. I'll get into this in more detail. I'll give you some individual trade ideas, targets, and levels, where to enter, where to buy if you want to go long. Some look better than others. But essentially, I've marked, this is a long-term chart going back to the start of the bull market, which was actually in tech and semis late, it was November of 08. Everything else in the stock market bottom March of 09, but that's late 08. Beautiful trend line, up to that point. That's our bull market trend line for a secular bull market in the semis, but there's been plenty of cyclical bear markets. And every one, again, if I missed anything, let me know. Divergent high, 29% drop. Divergent high, 28% drop. Divergent high, 27% drop. And I just call those really corrections. They're not bear markets. They're just bull market corrections. Semis are more volatile than the overall market. So the old 20% definition is antiquated, in my opinion, especially for a sector, something like this. Like natural gas can go up 20% in 2 days, and it does it all the time, so you wouldn't want to call that a bull or bear market. Divergent high, correction, 39%. Divergent high, hit my first, a little shy of my second target, 42% drop. So take that average, guys. I see almost 30, 20, 40, 40. We have a divergent high, clear negative divergence. It is still not confirmed. We still need to turn the PPO down. And if we do, I struggle to find a reason why I would think anything less than another 20 to 40+% drop. In fact, I updated this today. I'm looking for a 52% drop down to 271. Again, depending on if we reverse from where we're at today. If we go a little higher, we're going to just have big divergence here on the weekly. I'm going to draw that imagine that's a line tool. And it's going to look like this. We have a marginal new high, and then I'll call for a 60% drop down to 271. And I think it's going to look like this if you want to trade it. Down here, a little bounce, come down here, a little bounce, hit the trend line, a little bounce, and work our way down sometime in 2024, 2025. All right, guys, I'm going to wrap it up there. Again, let's see, let the dust settle for the FOMC post-Fed noise. And I don't know what else to add. You have my most of the trades, and I updated, I didn't do a full update on semis here. I'll get down to more near-term stuff in another video, and I also want to lay out some targets, some longer-term targets, or key levels to watch, let's just call it that, for 2024 and 2025. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.